Could this be as good as it gets for Goldman Sachs? Wall Street's most famous firm reported earnings this morning, and by many measures, they were good. Revenue and profit rose compared with the year-ago period and beat estimates, but Goldman's return on equity was just 12.4%. Nothing to get excited about, and the shares have been trading down this morning. Here to weigh in, two of the world's top authorities on everything Goldman. Brad Hintz, a top-rated analyst with Sanford C. Bernstein and former executive at Morgan Stanley and Lehman Brothers. Goldman is among his top picks. And Bloomberg contributing editor Bill Cohen, author of Money and Power, How Goldman Sachs Came to Rule the World. Brad, first question to you. Could this be as good as it gets?
No. We have the beginnings of an investment banking cycle, North America only, right? We have secular shift in terms of capital structures of banks in Europe. So as a result, you're seeing debt capital markets rising rapidly. The trading businesses are going to have a difficult time, right? And we're still in an evolutionary period in the trading business. But in terms of good as you can get, no. Goldman's dragging around a lot of surplus capital and a lot of surplus liquidity. And we've got regulators who probably won't let them get rid of that for another year or so.
You know, what's going to determine largely if the bottom line improves quickly, Bill, is going to be compensation, something that we've talked a lot about. Goldman Sachs, paying effectively 43% of its revenue out as compensation this quarter.
Which I might add is still a lot. I mean, as we know, traditionally, the investment banks pay out between 40 and 50 cents of every dollar of revenue in terms of compensation. It's the one big variable cost that these firms have, and it's not a surprise that they manage it very carefully, and it's probably that management of it is why they probably were able to beat earnings. But I would say, while it's not as good as it gets for Goldman Sachs, because it can always get better, especially if their trading engines kick in, it's about as good as it gets for investment banking. I mean, low interest rates means that all their, clients are going to borrow money, as much money as they possibly can. The stock market was rising precipitously in the first quarter, and so that means equity raising was, as strong as it's been in a long time. It was pretty good from an investment banking point of view.
Well, in terms of compensation, it's just all about cost cutting, and that's been a continual theme that we've seen throughout the earnings season. How is Lloyd Blankfein as a cost cutter, belt tightener relative to some of the other bank CEOs?
Goldman's actually ahead on the comp side. I mean, they've brought their comp ratio in more than the other players, and the numbers we've come up with imply that to beat your cost of capital under Basel III, you're going to have to bring down your risk-weighted assets by about 30% and bring your comp ratio down to about 40. And all that's going to do is just bring you to your cost of capital. So fundamentally, Goldman, we're seeing them bring RWA down. We're seeing them bring their comp ratio down. They're doing all the steps that we mathematically decided that you had to do. But they're looking forward to a day where they will make money in the fixed income side. Now it's difficult, right? It's difficult because picture it, you're a world famous fixed income prop trader. And, somebody's going to come up to you and say, thank you for your service. It's time for you to move on to a hedge fund, right? Because the world is changing. Bid-offer spreads are opening up in corporates. Trading volumes are dropping. And so the business model of trading is changing.
So I'm still a bit confused, because if we agree that conditions for a firm like Goldman Sachs are good right now, interest rates are low, they're not a commercial bank, so they don't get hit on the net interest margin the way that commercial banks do. Stock prices here in the United States are at a record. Credit spreads are tight. There's demand for new credit, as demonstrated by Goldman's record underwriting revenue on the debt side. How is it that it's going to get better if you don't believe that the economy is going to accelerate?
Well, if you don't believe...
I mean, they talked about their investment banking backlog being lower, right, than it was in the fourth quarter.
Right, but that one I would not terribly
Like, if you take the Bill Gross position that this is a new normal, right, that the economy isn't going to kick into 3 to 4% growth.
No, but we can, we have Europe that's weak, right? So if we were to look if we were to compare this to, say, 2005, 2006, it's one half of a 2005, 2006. We have the beginnings of financial sponsors coming into the marketplace. We really don't have the corporate strategic M&A coming in at all. We have a lot of deals waiting to be liquidated out of private equity funds. So, the calendar is full in terms of that side of the house.
But you were just telling us that the outlook for trading relatively speaking, ain't so hot.
Well, now, so, what you're saying is it as good as it's going to get? Trading is going to have a difficult time taking off from this point. And the reason is because they're not bringing VAR up, they're not increasing leverage, and their balance sheet is flat.
And how about the regulation?
Won't let them
Amen.
do it. And don't forget the black box that is Goldman Sachs. About 90% is trading. So while we can see and understand very easily, the debt and equity issuance, the M&A activity, that's very easy to comprehend, and it seems like that's growing and doing well. But on the fixed income trading side, who knows what they're really up to, and who knows where their derivative book is. And the regulators are basically saying to them, and this is even before the Volcker rule gets fully implemented, is saying, we're watching you very carefully. You can't do what you used to do.
It's good that you brought up regulation because, Brad, surely the new rules are showing up in everything from trading to capital ratios. And it sounds like from the bank CEO comments, they're bracing for more.
Well, the revenue return on trading assets of the industry has dropped. So, and Goldman has narrowed it. It's dropped relative, come closer to the pack. So Goldman's trading expertise has less value right now because they can't really deploy it as they used to. Their investment banking is perfectly fine. Their private equity business is in the stage of sort of evolving from equity to subordinated debt. And so what you're going to, what you've got is a merchant banking portfolio that's in the process of being liquidated with gains coming in and that. I look at Goldman and say it's an early cycle investment banking play, and you should be betting early cycle investment banking plays. Now, whether you want to do Greenhill, Lazard, Evercore, or you want to do Goldman or JPM, that's sort of a different argument.
What's your
right?
pick?
I like Goldman as a large cap play on this one.